Welcome to Financial Essentials, your guide to mastering your money. Have you ever heard that the stock market has created more millionaires than almost anything else in history? It's true, yet a huge number of people never invest a single dollar. Why? Because it feels complicated, risky, and frankly, a bit like a private club they weren't invited to. Today, we're changing that. We're breaking down Stocks 101, everything you need to know to understand how the market works, and how you can start investing with confidence, even if you're starting with just a few dollars. Let's demystify the world of investing together. So, what exactly is a stock? At its core, it's surprisingly simple. When you buy a stock, you're buying a tiny piece of ownership in a publicly traded company. Imagine a giant pizza. That pizza represents the entire company. Buying a stock is like buying one slice of that pizza. You're now a partial owner. If it's a popular company like Apple or Amazon, you're one of millions of owners, but you are an owner nonetheless. This means you have a claim on the company's assets and a share in its profits. If the company does well, makes smart decisions, and grows its business, the value of your slice, your share, goes up. If it struggles, the value of your share can go down. It's that direct link to the company's success that makes stock ownership so powerful. Now, where does all this buying and selling happen? It happens on stock exchanges like the New York Stock Exchange or the Nasdaq. Think of these exchanges as giant organized marketplaces. Just like a farmer's market where people buy and sell produce, stock exchanges are where investors buy and sell shares of companies. The price of each stock is determined by the simple yet powerful forces of supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people are trying to sell than buy, the price goes down. This constant tug of war is what makes stock prices move every single second the market is open. It's a dynamic global marketplace where billions of dollars change hands every day, all driven by the collective decisions of millions of investors. Let's dig deeper into why stock prices move. It's not random. There are many factors at play. First and foremost is company performance. When a company releases its earnings report, typically every 3 months, investors get a look under the hood. Are sales growing? Are profits increasing? If the news is good, investors get excited, demand for the stock increases, and the price often rises. Bad news can have the opposite effect. Then there are broader economic factors. Things like interest rates set by the central bank, inflation data, and unemployment numbers can affect the entire market. For instance, higher interest rates can make it more expensive for companies to borrow money, potentially hurting their growth and stock price. Company-specific news is also a huge driver. A successful new product launch like a new iPhone can send a company's stock soaring. Conversely, a major scandal, a data breach, or a product recall can cause investors to lose confidence and sell their shares, pushing the price down. Even things that haven't happened yet can move markets. Investor emotion and expectations play a massive role. Sometimes markets are driven more by the anticipation of what might happen in the future than by the reality of what is happening today. Fear and greed are powerful forces. A wave of optimism can create a bull market where prices rise, while widespread fear can trigger a bear market where prices fall. Understanding these drivers helps you see the bigger picture beyond the daily price wiggles. So, how do you actually make money from stocks? There are 2 primary ways. The first and most common is through capital appreciation or price increases. You buy a stock at one price and you sell it later at a higher price. The difference is your profit. If you buy a share for $100 and sell it for $150, you've made a $50 profit. This is the goal for most growth-oriented investors. The second way is through dividends. A dividend is a portion of a company's profits that it distributes to its shareholders. Think of it as a thank you gift for being an owner. Not all companies pay dividends. Many younger, high-growth companies prefer to reinvest all their profits back into the business to fuel more growth. But more established, stable companies often share the wealth. Dividends are usually paid quarterly and can provide a steady stream of income. The real magic happens when you reinvest those dividends. Instead of taking the cash, you use it to buy more shares of the same stock. This creates a powerful compounding effect. Your new shares can then earn their own dividends, which you can reinvest to buy even more shares. Over time, this cycle can dramatically accelerate the growth of your investment. It's like a snowball rolling down a hill, getting bigger and bigger on its own. Now, a big question for beginners is, should I buy individual stocks or something called an index fund? Let's break it down. Buying an individual stock, like a share of Tesla or Microsoft, means you are concentrating your risk. If that one company does phenomenally well, your potential for high returns is significant. However, if that company stumbles, your investment could lose a lot of value. It requires more research and a higher tolerance for risk. On the other hand, we have index funds and ETFs, which are exchange-traded funds. An index fund is a type of mutual fund that holds a collection of stocks designed to mirror a specific market index, like the S&P 500. The S&P 500 is an index that tracks the performance of 500 of the largest companies in the US. When you buy a share of an S&P 500 index fund, you're not just buying one company. You're instantly buying a tiny piece of all 500 of them. This provides instant diversification. If a few companies in the fund have a bad year, it's cushioned by the success of the others. The risk is spread out. For this reason, most financial experts agree that beginners should usually start with broad, low-cost index funds. They are a simple, effective, and lower-risk way to get started in the market. A common myth is that you need a lot of money to start investing. That's simply not true anymore. Thanks to financial innovation, the barriers to entry are lower than ever. One of the biggest game changers is fractional shares. This allows you to buy a portion of one share of a stock. So if a single share of a company costs $1,000, you don't need that much to invest. You can invest just $5 or $10 and own a small fraction of that share. This makes even the most expensive stocks accessible to everyone. Another fantastic tool for beginners is the Robo-Advisor. These are digital platforms that use algorithms to build and manage a diversified investment portfolio for you. You simply answer a few questions about your financial goals and risk tolerance, and the Robo-Advisor does the rest. They often use low-cost index funds and automatically rebalance your portfolio to keep it on track. Many also allow for automatic investing, where you can set up a recurring transfer from your bank account every week or month. The set-it-and-forget-it approach is perfect for building wealth consistently without having to think about it. And don't forget tax-advantaged accounts like a Roth IRA or a 401(k). These accounts offer significant tax benefits that can supercharge your long-term growth. Finally, let's cover some timeless rules for successful investing. First, start early. The sooner you start, the more time compounding has to work its magic. Even small amounts invested in your 20s can grow to be much larger than bigger amounts invested in your 40s. Second, consistency beats size. Investing $100 every single month is far more powerful than trying to invest a large lump sum once in a while. Automate it and make it a habit. Third, diversify. Don't put all your eggs in one basket. Spreading your money across different companies and industries, like you do with an index fund, is your best defense against risk. Fourth, and this is crucial, ignore the daily noise. The market goes up and down every day. Watching it constantly will only stress you out and tempt you to make emotional decisions, like selling in a panic. Investing is a long-term game. Think in terms of years and decades, not days and weeks. The most successful investors are often the ones who check their portfolios the least. When you understand the fundamentals, you realize that investing isn't gambling. It's a calculated, strategic plan for building wealth over time. It's about owning a piece of the global economy and participating in its growth. You now have the foundational knowledge to start your investing journey. It's not about getting rich quick. It's about building a secure financial future one step at a time. The power is in your hands. If you found this breakdown helpful, be sure to subscribe to Financial Essentials for more smart money education. We're here to empower you on your path to financial freedom. Thanks for watching, and we'll see you next time.